Next day I re-enter. Crossover. We didn't have that moving average crossover, not moving average. Price and signal line crossover coming back and retesting that same crossover there because it's not really visible and it's a little bit far. You understand? So for me, that's a very good setup there. What else do we have? Do we have divergence here? This is actually, yeah, this is divergence as well. So yeah, man, it's more or less the same thing over and over and over and over and over. We look for the same thing. Like you are very precise and specific. You only trade certain things on certain days. You don't just walk into a chart and be like, you know what you're looking for at what time, at what day. That is how easy it is. You understand? So I struggle to understand why people confuse themselves and then stay away from counter trending. If you wanna be a successful trader, stay away from counter trending. So this was also a very good high probability setup because it was Tuesday stop and right on top of that moving average 200 on 1 hour. So you see how this is 200 moving average bounce on 1 hour. So automatically I know on 15 minutes it's an 800 moving average bounce. On 4 hours it's 50 moving average bounce. So right here, there are three moving averages that are bouncing here, right there, by just looking at this chart, flash card, with 200 moving average on 1 hour. So automatically on 15 minutes it's 800, and then on 4 hours it's 50. So we have a nice high probability pattern there, and we also have a bullish engulfing. On TDI we have shark fin low, we have price and signal lines crossover, and then we don't have very oversold conditions, but then we do have level 1 safety trade because why? We have a 15 200 moving average crossover. Moving right along. What happened here? Okay. So yeah, man, that's it. In terms of, let's go back to our slides. So the TDI, we've seen the divergence. I don't trade much convergence because convergence is continuation of the trend, and then divergence is the reversal. So I don't look much at convergence. I have a lot of things that I look for, but then convergence, maybe you can do it and show it to us. So we've seen how the market sentiment, market baseline, translate some info to us as to when to enter short or long, which one is extremely overbought, oversold. You know, I look at overbought and oversold conditions, but then when the market is oversold, it's extremely overbought or extremely oversold. That's when I look at the market sentiment, like the market baseline. To confirm that the market is extremely overbought, I will look at where the market baseline is trading. Is it trading above the let me see what is it trading above the 63 and the 68? You see this for me it's extremely overbought conditions. Why? Because the market baseline is trading above the 68 line, and there's also major divergence there. And then what else do we have? You have divergence. We had shark fin highs there, and then you see this crossover. What happened here? There was a crossover there, price and signal lines, and then also the market baseline. And what it did, it came back, retested that crossover the price line, but then there's still huge major divergence there. So from here onwards, the price is gonna take a huge dip, and then there's also an upper squeeze. You understand? So you should also it's just that I didn't put it in here. Let me just go to those slides. So there should also be like a squeeze, like an upper squeeze and a lower squeeze, because that's also a very high probability setup that if you see a squeeze that is on the upside or on the downside, which is squeezed together above the 38 or the 67 support and resistance lines, then there's a very good setup. So we're just gonna do the ADR, AWR, and then work time auto GMT. So the ADR and the weekly price range. Let's just go to our chart. Let me just remove everything there. Starting with my let's remove that. The TDI is actually very simple. Oh, you know what? Let me just go to this the American dollar. Yeah. So this is an ADR high. This is an ADR low. For me to take a short position, If ever this ADR high, if ever price comes to these levels and also give issues as a pin on that ADR high, I take it, I don't leave it. Let me show you something real quick. Yeah, so this is what I want to show you. You don't just use ADR on its own. You use it with confluence of other things. As you can see here, this I was expecting this the first week or the second week. Or this was Friday. As you can see, this was the third. The third was Friday, and this was Monday accumulation. Tuesday stop hunt. So I was expecting stop hunts, but then my stop hunts I wasn't expecting a stop hunt low. I was expecting a stop hunt high, then drop. Understand? So I didn't get a stop and high on London. So if I didn't get on London, I need to wait for New York. I waited for New York. It came here. So at that precisely at that time between 2:30 and 4, I took that short position. Why? It was Tuesday stop and high. It was on that ATR high. This was potentially the lowest, the highest price of the day, because the highest price of the week was established the previous day, and you can see how close was that previous day high there. So I knew this area was a high value area that I should start looking to take the short positions, and I did, and then specifically because it was that ATR high there. So give it that ATR high, and then trigger positions, short position, and it fell. As you can see, it's New York reversal, it's Tuesday stop hunt high, it's high price of day, it's ADR high, vector 3 candles signifying a stop hunt. There's an outside structure stop hunt because those highs are just above that new Asian session highs. It's a head and shoulders pattern, left shoulder, the head and the right shoulder. It spikes to the high there. There's an evening star and then railroad tracks there. Guess what? There's divergence on the TDI. Where do we have the divergence? There it is. It's going up there, but then it's going down, signifying that the market has lost momentum of continuing with an uptrend. There's blood in water. Do we have blood in water? Yeah, we do. Now we have blood in water. This is blood in water. You know why? Because the signal line is trading on top of the upper volatility band. So this upper volatility band is supposed to be blue in color. So when the blue goes into red, it's blood in water. So we have shark fin high, we have blood in water, we have uh, uh, crossover between the price and the signal lines. We have overbought conditions here. Understand? This is overbought conditions. And then what else do we have? Yeah, that's it. Let's look at another one. The same thing. It was Tuesday, Monday accumulation, Tuesday stop and low. Because you can see this was the third, it was Friday, Monday, Tuesday stop and low, London stop and then didn't go anywhere. New York open, price flight. It I don't know if I say okay, it's cool. Let me just not get into that. But then as you can see, it was a very nice buy here with lowest possible risk, having price touched that ATR low. As you can see, you have everything there. You can just go through it. Another one there it is there. And then so an ADR, this is a Mona Lisa for me. This was the best. That is why I like the dollar across the board, because it gives us that those nice runs. So imagine having taken that position. It's 2, 4, 6, 8, 10. So it's like two it's like 5 2 minute positions with 165 uh, uh, peps. So I'm just gonna calculate how much was that in terms of in monetary value. Two times 165. It's 100 and 330. Yeah, 330. 330, 369, 12, 15, 15 plus 150, 1650. So we made about $1,650 from here to there in like I don't know how long, because we took these positions around the first touch, second touch. This was a very beautiful one. As you can see, it's a stop and low, vector 3 candles, and then it's an outside structure, market make outside structure, stop hunt. There's potentially the lowest price of the month. It's the second week. It's the first week, but then it's Tuesday. Remember, so it's actually the second week, because the first week was the third. On Friday was the third. So that was the first week. This was the second week. Second week of February 2016 or 2017. I'm just not sure. We took a long position, gave us a nice Tuesday stop and low. Gave it's a Brinks trade. It's a Brinks trade, like as Steve would say, Brinks trade on that ADR low, and then New York Open issued us with railroad tracks. You can see we have some beautiful morning star formations there, and then some rejection signals there. So we take it high within within 4 or 5 hours. You already accumulated more than 700 and 365. It's 3 6 $765, 765 peps in just one day. You understand? So you just need to use them in confluence. That is how you use the ATR. So when it comes to average weekly range, let's go to the charts. You don't get that. You don't get the average weekly range. You just need to be able to calculate it yourself. So what I do is that I would just draw my weekly cycles like that, from the highest to the low. From the highest to the low. No, actually, let me just show you something real quick. Where's that document? Let me just open that document. Okay, let me just put it in here. I just want to show you something real quick. So you can calculate any range, whether it's weekly range or whether it's monthly range. So what you would do, you would count your how many pips is it from. Let's start from January here, from this low price to that high price. Maybe it's like you bought here in big one. How many pips did we make from that high, or it's actually from here until there at the top. So but then it's cool. So from this high to that low, let's just say it's 300 pips. It's 300 pips, and then from that high, from this low to that high is 280. From this low it's 150. From that high to this low it's maybe 450. So you just add them together. 350 plus 280 plus 180 plus 450. They would give you maybe like 1800 pips. 1800, then you divide it by 4, then you get the average weekly range on this pair. I don't just do it with 1 month. I would just add like 3 months or 4 months with adding just weekly ranges from the high to the low. I would just calculate for how much is it from here to there, and I'll write for 335. Then I'll write them for like four weeks or 4 months or 5 months, and then I will just calculate that, and then I will then get my average weekly range. Then I know if I take a stop and low here. If it's gold, then any pair that I take if I take a stop and low on Tuesday, I know on average I have to get like 300 pip 100 pip movement. So which means minimum that I have to get on one position on average has to be 300 pips if I take it from stop and high to reversal on Friday. That's how you know how many pips is it left from level 1, how many pips potentially could it be until level 2, because you also have the average daily range, you have the average weekly range, and you can, when you have the average daily range, you can calculate to yourself average weekly range and the average monthly range. It's very important for you to have these numbers. It's your numbers, it's not mine. These are my numbers, so you have to create your own numbers, you understand, so that you'll be able to see even on a bad week or on a bad month how many positions on average do you win, how many positions do you lose, and on average how much do you make, and so forth. You understand? I have my statistics. These are my numbers. You have to create your own numbers. As you can see, man, these are very consistent. When you enter here, you hold because you know it's the second week of the month. You're gonna make how many monthly range is 659. So from this low to that high, it's 659 pips. So imagine if you enter five positions here, you enter five here, you enter five here, you enter five here, you enter five here. You're gonna make like 10,000 pips and become a millionaire like 1 year. So I'm not saying you don't use proper equity risk management. It is proper risk management and equity management. It's just that people, they don't know when to buy or sell and how long to hold. That is why they are not able to hold positions for a long time. Like as I'm saying right now, I've been holding some positions for a few months, from since October, November, December. I'm still holding some positions right now, and I've been trading. I haven't been trading for a few weeks now. You understand? Here's another one. You buy there, you buy there, you buy there. You collect 720 pips from this trade. 720 here, 650 here, 530 here. Altogether, it's like 4,500 pips. You got paid. Multiply by standard lots. It's how much? $45,000. $45,000 multiplied, converted to South African rand is how much? Three quarters of a million. Yeah, I think it's around about that. 700,000 rands. Yeah. So it's the same thing over and over and over and over. The same thing that I'm showing to you right now. It's the same things that I've been doing for the past five, 3, 4, 5 years. You understand? So as you can see, you know what I mentioned, that on NFP Friday first week, It's either we get a midweek reversal or a Friday NFP reversal. Here it is right here. This was NFP. We got that NFP pin, and then voila, price rallied. As people, I'm surprised people say, "Hey, NFP, we trade NFP." I'm like, you will get banned. So these are my numbers on average when it comes to the gold. I know this was 2017. I collected 33,000 peps with how many positions? 77, and then on average I collect 625 peps per trade. Average monthly, no, this is the average monthly range. So on average, gold moves 600 peps from the lowest price to the lowest to the highest price. You understand? And then average weekly range is 300 pips. So from the lowest price to the highest price. Lowest price meaning Tuesday stop hunt until the highest price, which is the Thursday Friday reversal. You should have a minimum of 295 pips. So if you're able to enter at that lowest possible, uh, with that lowest possible risk, you would be able to get a very good risk reward, because you know if you take you with lowest possible risk, you will risk about 50 pips minimum, maximum, and then look at this reward. It's like 1 to 6, so that's a very good risk reward. So guys, we've been doing this for years, man. It's experience. These things where you just need to have a proper, version, or not version, a proper way of analyzing and make it work for you. Own it. You understand? So let's go back to the slides before I can just finally conclude this section here, indicator section. So the work time Novoto GMT, it's an intraday trading session indicator which shows us the Asian, which displays or colors, uh, has a color coding when the Asian session is in play, the London and the New York sessions. So, but then I guess you already know that because it's the first thing that you see when using the market makers template. So I'm just gonna put that in. Let me just go to a different currency pair. So I'm just gonna put that in here. No time auto GMT. There it is. So this is simple, guys. Look at what I use. For me, if you living in a different time zone, maybe you would use this work time, or maybe just the GMT offset. Just work between GMT offset, work time, and no auto GMT. Then you'll be able to find your exact time zones. So for me, I use the in South African time. I use the work time no auto GMT. That is my time. Understand? So this is the Asian session. It's color coded. This is the beginning of the London session between of us. The Asian session starts at 12 o'clock midnight, ends at 7 o'clock in the morning. So you'll be able to say it for me, because this indicator will throw all this for you. Beginning of London Open, you'll get a shadow box where it will signify you where to take your where the stop hands are most likely to occur. As you can see here, between of course 8 and 10. I didn't draw this. The template that does this. You will see London Open, and then later in the New York session, New York Open later in the afternoon between of course 8, half past 2, and 4 o'clock. So this is what it does. Otherwise, if you want to use uh, what do you call this, more indicators, market makers indicators, just make sure that you know just scan them through, because when you put it in like that market makers template, it's like this, and then these are not my time zone, so I need to take it back and then make sure that it's on my exact time zones. This is it, you understand? This is my times. So it's very easy and straightforward. You just need to change that real quick. It's aqua, not tail, pale turquoise. It's aqua. Let me change the thickness, put it to level 2 and that. And basically that is how you also customize your template. So this is it. Let me just remove what I don't use. Pivots, I don't like them, I don't use them. And then let me also remove work time auto GMT. And then day high lows, it's this one. I also don't use it because for me personally it works sometimes, so I'll put it on when I want to use it. So you can see it's very nice and clean, it's straightforward. That is how you customize your market makers template. You understand? So you're good to go. So I believe we've covered everything that we need to know in terms of moving averages, Fibonacci, TDI, and then average daily and weekly ranges, and then the work time no auto GMT indicator. So thank you, ladies and gentlemen. And then the next chapter is it's high probability trading, currency setups, entries, exits, and confluences. This is where it gets late. So stay tuned.